Hi there, welcome to Berman's Call. I'm Andrew Bell in today for Morella Fernandez, and Larry Berman is here to take your questions on both stocks and ETFs. You can reach Larry toll free 1-855-326-6266, or there's the email address bermanscall@bnnbloomberg.ca. Larry, thanks very much for joining us. We've seen another rally today in the big US tech stocks. You anticipate more volatility, though?
Yeah, I think so. Following NVIDIA's earnings last week, we saw initial excitement about it, and the marketplace really sold into it. So despite the fact that the market's excited today about maybe the Fed cutting rates in December, which we saw a little bit of a pivot on Friday in the marketplace sentiment around that, I don't think this is the beginning of another new up leg for the market. So, for the investor type who is concerned about valuation, today's pop is probably a good opportunity to rebalance and take some money off the table, perhaps maybe get into some more defensive holdings as opposed to thinking this is the beginning of another move higher in equities. I think the volatility is going to be here for quite a while. We're seeing it in a lot of risk assets, like Bitcoin and of course, the AI trade.
It's interesting as well. People sort of lump them all together, the AI stocks. But there will be winners and losers. Alphabet stock hit a record high today. It's getting great reviews for the latest version of Gemini, its AI program. But I guess the point I'm trying to make is that if it does well, it could hurt OpenAI and OpenAI's customers.
Well, it could, but remember, OpenAI is a private company, so it wouldn't impact the public markets at all. There has been some chatter in the public market or the private market community about the valuation of OpenAI and their latest round of investment, and that might be, getting ahead of itself. Peter Thiel, for example, sold his exposure to NVIDIA. Warren Buffett and Berkshire Hathaway bought into Google. So there's a bit of a rotation going on. The leadership does change in these market cycles. And Google for now looks to be a big winner of that. So maybe a bit more upside for Google here. Everybody hated Google universally a year ago.
Isn't that funny? Yeah, people thought maybe you'll put up a 1 year for Google. People thought, their regular search business is going to be hollowed out here.
Exactly, and it turns out they're now with the leadership of this because the infrastructure is there. Everyone else is building the search infrastructure. I'm still going to default to my Google. I don't know about 5 or 10 years from now, will I use some of these other agents to do my searches? But for now, it's Google, and I think that's a big advantage for them.
Larry, we better leave it there. Oh, just finally, give us your thoughts on Bitcoin. I know you're not a huge Bitcoin fan. Maybe we'll put up a 1 year chart for Bitcoin. It has seen some selling. Go ahead.
It has, and it will again. And this is something that when more and more retail investors, the end investor, gets involved. So the explosion of Bitcoin ETFs. For example, in the last year, coming out of the U.S., the push of the industry to get individual investors invested in Bitcoin, the sharp move up we saw a year ago when President Trump got elected, has all been wiped out. Well, almost all of it, anyways, at the recent lows. So it's a volatile asset. It's correlated to equities. It's not an uncorrelated asset like the argument was a few years ago. And so when the markets go risk off, something like Bitcoin is going to come down. Because it's more volatile than most things, it should be looked at as a leading indicator. It was breaking down far before equities started to weaken off in the last couple of weeks.
We'd better jump. Larry is here to take your questions on ETFs, on large cap stocks. The number, there it is, 1-855-326-6266. We have an email from Anthony. Could you give me your view on MSTE, which is the Harvest MicroStrategy Enhanced High Income ETF?
So this is a leveraged play on Bitcoin. Michael Saylor, MicroStrategy fame, turned this thing into what I believe is ultimately going to blow up every investor that touches it, and that it's a leveraged play on Bitcoin. The natural volatility in Bitcoin tells me this is going to wipe out at some point. I don't know when, but you get a 50-60% correction in Bitcoin, and this thing goes to zero. So avoid, and if I can add 3 more avoids to that. This is not for anybody but a day trader kind of thing that wants to play leveraged Bitcoin. It's a terrible investment.
Hang on, Larry. I see. Yeah, it invests in MicroStrategy. You wouldn't really know it from the name. I see. Yeah. MicroStrategy being now called strategy, which it's just a way of holding Bitcoin. That's interesting. Yeah. Yeah. And you're no fan of these things anyway. And of course, you got the double.
I am no fan. And people will tell me you're a bitter old man who doesn't understand the new technology. And, fair enough. I'll give you that one. But the reality is it's an incredible volatile speculative asset. Mm-hmm. And if you want to trade it, go ahead. But it's not for investors.
Okay. Yeah. Yeah. Okay. They say we use modest leverage, but they use an active covered call strategy. Okay. Thank you for that question, though, Anthony. Robert is in Montreal. Go ahead, Robert, please.
Hi, Larry. I'm just wondering what you think about Canadian Tire, CTCA, and whether I should sell to get tax harvesting or hold on. Some analysis seem to think that it might move another 20% up.
Thanks.
Thank you.
Yeah, so Canadian Tire is covered by all the big banks here in Canada. When you look at the 1-year forward price target, call it 175-ish. The most bullish analyst probably thinks it's worth 211. I see at RBC, and the most bearish right now looks to be 155 at Scotiabank. So that's a pretty broad range by 2 analysts that otherwise should probably have more narrow of a spread. And so is it going down or is it going up? And I would say right here, if tax loss makes sense to you, do some tax loss selling, try to accumulate it, somewhere below where the most bearish analyst thinks it's worth a year from now. So that, would be a buy, say somewhere below 150 at this point.
Okay, let's head to Oakville, Ontario. Renata, go ahead, please.
Hi, good afternoon. Larry, I'd like your opinion on TELUS. What the heck is happening to that company? And I'd like your straightforward, honest opinion. I'll hang up and look forward to it. Thank you so much.
Thanks.
It's what's happening to TELUS is the same thing that's happening to BCE, the same thing that's happening to Rogers in general, and that is generally a dislike for the sector overall. And I've said many times here, for the dividend clippers that like the telcos, the better exposure is ZWU, and that's going to give you a much better, more reliable dividend income stream and give you exposure to the same sectors and some others, and it gives you just a better income in a more diversified way. So I think there could be some more tax loss selling going on here. Probably leads to a very good buying opportunity. But like we saw with BCE, the recoveries have been limited, and it's probably a number of years off before you could think about any of these stocks in the sector as a fundamental buy.
Okay, and TELUS would compete with our parent company, BCE. Ken is in Vancouver. Go ahead, Ken, please.
Oh, hello. I'm wondering what your opinion is on ZCOM, this BMO Broad Commodity ETF. I think it's the only one in Canada. Do you think it's a good buy as a addition to a portfolio?
Thanks.
Thank you.
Yeah, so here's the thing with commodity prices. I wish I had a chart on this, because if you go back 50 years. You go back to the early 70s when commodity futures really first started trading, and you look at, what is the absolute total return? It's 2 or 3% a year. And commodities will do well when nominal growth is strong. That means the real economy is working and inflation is picking up. So in that environment, commodities are going to outperform most other assets. But in an environment where you don't have strong nominal GDP, historically, commodity prices have underperformed. So I like ZCOM as a vehicle to deliver the exposure. I just don't like it right here. 10% lower, I think ZCOM could be added to portfolios on a valuation basis. I'm going to talk about oil and gas a little bit at the end of today's show, and I'm a little bit worried in the short run that we're going to have a little bit of commodity price weakness before we could see any material strength at this point. So cautious. I like it longer term, but I would buy it on a dip. I wouldn't add it here.
Let's head to BC. We have Eldon on the line. Go ahead, Eldon.
Yeah, good afternoon, Larry. I'm recently retired and looking for more of a monthly income. So I'm looking to sell some of my stocks that are winners, and I'm looking at HHIS. I did pick up the oil and gas ones a couple weeks ago that you had recommended. Thank you. Just wondering if HHIS or if you have a different one for a nice income monthly. Thank you.
Yeah, so HHIS is going to give you exposure to a lot of their covered call, enhanced big tech flyers, and it's an interesting income-oriented strategy to be involved in big tech. But if overall big tech is high valuation, it's not a good time to put new money in it. If you want something again more stable, more dividend-like, after a big correction in the markets, the next sort of bear market where you see a valuation correction, then I'm okay with HHIS. I just don't like the timing of it right here. It's a good vehicle to generate income from technology in general. I just don't like the timing of it at the moment. So those are my thoughts there. I would much be more defensive in the ZWU, where you've got utilities that aren't crazy overvalued at the moment and generating that same kind of dividend you're hoping to get, that income with pretty favorable tax treatment.
Okay, we have Jeff sending us an email here. I want to expand my European holdings. Two options Jeff thinks look interesting, ZDM and ZEA. Which do you prefer, i.e. hedged or unhedged? And of course, that means hedged to the currency or not.
That's right. So, the Canadian dollar relative to the world has been very, very weak for quite a while. That probably continues until, the current government, if possible, can right-size the Canadian economy. And get us to grow again. So we're knee deep in recession now. Probably means the Canadian dollar continues to underperform, which means you want to be hedged for now. At some point, you want to be unhedged. But right now, with that you want to be unhedged with that foreign currency exposure. At some point, when the Canadian dollar looks to be stronger and improve relative to the world, you want to hedge that foreign currency exposure. So ZEA right now. And at some point, you'd rotate that if you were making a move into international developed markets.
Okay, we have an email from John. Could I get Larry's opinion on JEPI and JEPQ? And they are the JP Morgan Equity Premium ETF in New York and Equity Premium Income ETF.
Yeah, so JEPI promises you a return that's trying to capture the total return of the S&P 500 with an option strategy to dampen volatility and deliver some extra enhanced yield. And the JEPQ is the similar thing for the NASDAQ 100. The strategy has underperformed a little bit. Some of the innovator ETFs that are designed to give you, again, upside capture and downside risk mitigation. So I like the innovator ETFs better longer term exposure. Nothing wrong with JetB or JetQ, but they've underperformed the other ones, over the ups and downs in the last number of years. So I'd have a preference there. Right here, right now, you're not going to get a whole lot of downside protection, although you're going to get some in both of those vehicles.
Okay, we have an email from Dave. Dave is asking about MDA Space. Is this a good entry point?
I was just at a private equity conference in New York last week, and one of the big areas of investment down the road is space. And so MDA, I got caught up in that speculative frenzy, I would say, in the last year or two, and now it's come back to earth, if I can have a play on words there. At this valuation, it looks interesting to me, but it does get caught up in that space kind of race, and it'll have its moments. I don't know really the fundamentals of the company very well. It's not a name that's in my universe or that I trade, so I can't add a whole lot of value other than to say it's okay priced at the moment. But you just got to be wary that it's in the space race, and it'll have some volatility when that sector's hot and not.
Mm-hmm. Okay. Okay. From space down to Earth. Any thought? Email from Steve. Any thoughts on Labrador Iron Ore Royalty (LIF)?
I like a lot of the royalty metals plays. You have a lot less risk in terms of exposure to the mining and having your revenues based off of being able to pull a profitable piece of material out of the ground. So the iron ore space is really a big part of steel, into the future and infrastructure. And I think we need a lot of that going forward in terms of building and expansion. But there are other technologies that are coming along that are going to give the steel sector a bit of a challenge. And from that perspective, I will put it cautiously optimistic, on the name. You do not want to chase it into strength. Again, it's the kind of exposure that buying into corrections, if you want to play it and you want to seek the nice yield that it offers. A year from now, analysts think this is worth $30, $31. It's trading at 28. I like it closer to 26, 27. I don't think it's going to get anywhere above 32 or 33, for 2 or 3 years. So that's the range. I'd prefer to buy it when it's cheaper than when it's expensive. And it's likely just going to chop around sideways for a number of years.
Coming up, Larry's educational segment. He's going to focus on oil prices. We'll be right back.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Time for Larry's educational segment. Take it away, Larry, please.
So, Andy, the Energy Information Agency, in their last update, which was out about a month ago, is forecasting the peak in U.S. oil and gas supply, looking out over the next number of years. And we have a chart of that right now. At the same time, you've got what looks to be some progress in ending the Russia-Ukraine war. So we could see a combination in the short run where you have the U.S. administration wanting oil prices to stay flat or lower for another year, at least until the midterm elections. You have the OPEC plus that has been over pumping, and then you have peak supply in the U.S. So when you add all those things up, it probably tells you that short-term oil prices could stay weak. That's really some of the forecast over the next few quarters. But when you think about longer term, you do have the Strategic Petroleum Reserve that's going to be replenished. I don't think in a big way until after the U.S. midterm elections, but at some point they're going to want to buy all that oil reserve back. When you look at the total return, so the next chart here, when you look at the total return of the energy ETFs for Canada and the US. So you have the XEG, which is the Canadian cap-weighted ETF, and then you have XLE for the US. When you look at the total return over the last 25 years, it's around 7% a year. They're very similar. They kind of go up and down together, as you can see there, quite uniformly. When you look at the dividend and the income part of it, about 60% of the total return has come off dividends. So in the last 25 years, you've had very little capital appreciation. And in fact, since the peak of oil after the financial crisis in the US, you've actually had zero capital gain, and it's all been income. So this is not a growth sector. Anybody who thinks it's a growth sector is I think, missing the mark. There has been a lack of investment in the sector for a number of years in terms of new supply, and that's why they're saying we're probably at the point of peak supply. So it does set up a bullish scenario looking out a couple of years. And so the final chart here that I want to suggest is in the short run for the income-oriented investors, ENCC, which is more Canadian focused, and ZWEN, which is more of a global focused exposure, covered call ETF to play the energy sector. So I like parking money here now in the covered call ETFs. And then for XEG and XLE, when we get a correction in the 5 to 10% range from the current levels of those ETFs for more of the growthier players. But when asked about where do I put my money today, there's not a lot of places that I'm seeing other than right now oil and gas on the energy side.
Larry, we better leave it there. Thank you very much. We're out of time on Berman's call. You can follow Larry, among other places, at his website, qwealth.com. Thanks very much indeed for watching. The close is coming up next.